folks like you with physicians and their families. Ask if you can get a reference, Google them, look for thought leadership. Are they writing online? Are they well known in the industry? Job titles don't tell you very much, unfortunately. There's very little title protection in Canada. Ontario's taking steps to help this, but for the most part, the title that somebody has doesn't really tell you a lot about what they do. So interview a few people and do your research. Okay, so lifestyle creep in the hedonic treadmill. So this is very, very common. Look, I mean, you've all worked very, very hard to get to where you are. And many of those years, I'm sure, were grueling and difficult as students and residents. And what I find with a lot of early career physicians is as soon as earnings jump, that when you become an attending physician and earnings jump and increase quite dramatically, it's very common to want to reward yourself. And obviously you should, and you deserve that. But expenses can creep up really, really quickly. And the more sort of addicted you get to the lifestyle that you deserve but are creating for yourself, the more difficult it becomes to sustain that lifestyle post work. So what I mean by that is you're essentially spending too much money, and that means there's less to save. But on the other side, you've created a lifestyle that you want to continue into retirement, right? And but by our mid 40s or so, we know what we like and we know the lifestyles that we've become accustomed to. So from a retirement planning perspective, it becomes very, very difficult to plan for because your savings have been too low because you've been spending too much, but you become addicted to this. Not addicted, but you're comfortable in the lifestyle. And so to fund that lifestyle after you're working becomes even more expensive. So you have this effect of not saving enough. Even more is needed for retirement. And it just means that you're going to potentially spend or face a spending cliff in retirement where what's actually sustainable is significantly less than the lifestyle that you've become accustomed to. So, I mean,
any headsets you need with a microphone on it?
oh, sorry, I think somebody's got their microphone on there.
Yeah, just mute them. Sorry about that. Keep it
Okay,
going.
yep. So there's good research to show that the satisfaction that we get from a new purchase doesn't really last very long. Collecting things doesn't really help. I had a client once that collected antique airplanes, like not toy airplanes, but actual airplanes. And so that was a very interesting retirement planning case because he wanted to keep collecting airplanes, and the retirement plan was not going to be sufficient to keep buying planes. So just be careful. Watch out for lifestyle creep, where your expenses tend to grow. Automate your savings and investment contributions. Try to do that earlier on. Don't try to play catch up later in life. It becomes very, very difficult. In that vein, comparing yourself to your peers. So we all do this, of course, to our peer group. We compare ourselves, I think, financially. Doctors are, in my experience, quite notorious for this, and I've had clients ask me that question specifically: how am I doing compared to my peers? And it's very difficult to determine just using outward facing metrics whether or not somebody is doing well. And I'm reminded of a time when I was driving in Vancouver with a friend of mine who's also an advisor, and we saw a flashy car. It was a Lamborghini or something, very, very flashy. And we looked over at the car, and my friend said, "I wonder how much money that guy has." And I turned to him and I said, "I wonder how much debt that guy has." Because it's very, very difficult to determine what someone's financial situation is just by looking at the things they have, right? Wealth comes in many, many forms, not just financial wealth. We don't know where it comes from. I've had clients with tens and tens of millions of dollars that were not, where one spouse was a physician, but the primary wealth came from a spouse or an inheritance or something like that. So don't look to your peers to necessarily determine where you are in your financial journey because it's very personal, and focus on yourself, focus on your own journey, your own goals, your own values, and really you're only competing with yourself at the end of the day. Okay, so tax is important. It's not the only thing that's important in financial planning. I see a lot of people disproportionately focusing on tax and tax reduction as the ultimate goal. And that's not really the goal. You don't actually want to pay less tax. You want the better after-tax outcome. And sometimes that can mean higher tax bills over your lifetime. What I mean by that is if you want to pay less tax, just stop working and don't earn any money, right? I mean, that's pretty simple. If anything you earn, stick it under your mattress, don't earn any investment income on it, and you won't pay any tax. But that's not actually the goal, is it? You're not trying to pay less tax. You're trying to achieve better after-tax outcomes. And tax is only a component of your financial plan. As I mentioned, you definitely need good tax professionals. I spend a lot of my time talking with my clients' accountants. They're fantastic and we need them. Generally speaking, accountants tend to look at the current year, the past year, and maybe the next year, but they're not always planners, right? When we plan with clients and when you're doing your own planning, you need to be looking decades out. And so tax is very difficult to predict over those timeframes anyway. So don't focus too much just on trying to reduce tax today, because it might not actually be the best after-tax outcome. There's many complex strategies out there that were designed specifically to reduce tax. And anytime you're engaging in a complex tax strategy, you're usually taking on some tax risk. The Canadian Income Tax Act is over 1 million words and over 3,000 pages long, and it does not cover every potential situation that Canadians might come across. And so there's some pretty creative ways out there to try to reduce tax. But again, most of those aren't written right into the Income Tax Act. And so there's some tax risk that if CRA ever looked at some of these strategies, they might say, well, no, that's not okay, and assess, back taxes and penalties. So anytime you're looking at a complex tax strategy, make sure you're working with professionals. Don't get a myopic focus on tax. It's only one part of it. Tax planning runs through every thread of your financial lives. Reduce tax where possible, defer it, deduct what you can, try to divide it with family members, but don't forget the rest of your financial plan as well. And kind of attached to that is financial planning is also more than investing. Many folks think that financial advice is just picking funds. If I can just buy a low-cost ETF, I'm done. As many of you know, it's a lot more complex than that, especially those of you who have a professional medical corporation. Things get very, very complicated. So investing is only one component of financial planning. I mean, much like health, right? Health isn't just about diet. It's not just about exercise. It's a combination of factors that determine your overall health level, and neglecting one area can impact others, right? So tax is important, investing is important, but so are other things like behavioral issues and spending patterns and debt management and everything else. So again, investing, very, very important, tax, very important, but beware of the other components of your financial plan. Like, you'll make thousands of financial decisions over your lifetime. It's not all just about investing and tax. Understanding the importance of time. Again, this kind of ties into one of the first slides, where we tend to think we can catch up later. And many of us can, and many will, but getting started early is so powerful over the long run. And we have these biases, many biases, but one is exponential growth bias. And we misunderstand how small amounts of growth over long periods of time tends to compound into very, very large numbers. And I put this out in the slide, but 99% of Warren Buffett's wealth came after his 65th birthday, right? And that's because he had been compounding at high returns on his investment portfolio for decades and decades and decades. And that snowball effect really takes off at the long end of that time horizon. So you'll see in the slide here, somebody who started with $5,000 a year for a decade and then doesn't invest again will actually have more wealth at the end than somebody who started 10 years later but invests for 30 years, right? And it's because that early, that first 10 years compounding for so many more years has such a huge exponential effect, right? Now, this assumes an 8% return. Whether you think that's reasonable or not doesn't really matter. The idea is save early, save regularly, save often. We tend to value things significantly more today than we do in the future. And so we tend to overspend. Like, if somebody offered you $100 today versus $120 next week, most people take the $100 today. But if somebody offers you $100 1 year from now, or $120 1 year and 1 week from now, people will generally say, no, I'll take the $120 1 year and 1 week later, right? So we place a disproportionate amount of value on rewards today. It's called hyperbolic discounting. So we really misunderstand the power of time in our financial plans and in our investment portfolios. The financial news media is designed to get your attention. Right now, it's all sort of about the election, but generally speaking, they're not trying to educate you or help you make great decisions most of the time. And I'm more specifically talking about, like, BNN and Bloomberg and stock news. This is not very helpful for the most part, right? Markets incorporate information into asset prices like stocks very, very quickly. For example, if you ever watch Elon Musk tweet about Twitter, by the time you've opened your phone to check the stock price of one of his companies, the news has already been baked in, right? If he tweets about Tesla, you open your phone, you check, the price has already moved. So markets tend to incorporate information very, very quickly. And anything that you see on the financial news is very likely to be priced in. So there's not really an advantage for most people using news to make financial decisions. And even if you predict something correctly, an event, you're very unlikely, or it doesn't necessarily follow that the impact will be what you think it is. And a good example of this was in 2016. I had a client who called me a couple of days before the election, And she said, sell everything, sell all of my US stocks, put everything in cash. I am terrified that Trump is going to win the election. And I told her, maybe he will, maybe he won't. We don't know what the impacts are going to be. We shouldn't try to time things like this. And of course, she was right. Trump was elected, but where she was wrong was the impact of the market was substantial, and stock markets grew quite a bit. And so she had sold to cash and ended up staying in cash for a few years, unable to get back in simply because of this bias. So, like personally, I check my portfolio maybe once a year, like maybe, and that's usually by accident because I have to do something, like I have to make a contribution or something. But I rarely ever check my portfolio. As long as you've got a solid, long-term, well thought out, well researched investment portfolio, a well diversified portfolio. These are long term in nature. You don't need to make short term decisions. Portfolios like that generally do not need to be tweaked simply because of some news that's out there. I can't remember who said it. It might have been Jack Bogle as well, who's quoted on the slide here. But somebody said, "Don't just do something, stand there." And I think that applies very, very well to investment portfolios and sort of ignoring what's going on in the media. So in that same vein, you're smart, markets are smarter. That's not meant to be an insult. It's just that markets incorporate information very, very quickly, and it's the aggregate information of all participants that are priced into stock markets. So on the slide here, you can see that almost $1 trillion flows through markets every single day. And it's those dollars that are setting prices, right? These are hedge funds, these are algorithmic traders and high frequency traders and mutual funds and endowment funds and retail investors, all buying and selling assets, stocks and bonds, based on the information they have. So that information gets priced in very, very, very quickly. In the same vein as the news slide, any information that you have is unlikely to not be in the market already. Like if you're competing with the aggregate information of everybody participating, it's unlikely that there's something that you know that the market doesn't know already. And we can see this in an experiment with a jar of jelly beans. And I think a lot of us are familiar with this kind of game where you fill a jar with jelly beans and then a bunch of people take a guess at how many beans are in the jar, and the closest guess wins the jar. So if you look at the individual guesses, they tend to vary very, very widely, right? There'll be a huge amount of dispersion in the number of jelly beans that any one person guesses is in that jar. But within a large enough sample, if you take the average guess, it's often very, very close to the actual number of jelly beans. And markets basically work the same way. Everybody's trying to make an average guess of what stock prices are. Markets aren't perfect. They're not perfectly efficient all the time, but they're generally efficient most of the time. Shiny object syndrome. So the financial industry is really, really good at selling you whatever they think you will buy. And so we see this all the time with new investment products that are launched on a daily basis almost with whatever the new hot investment trend is, right? And we can look at this over time. We can look back to the tech crash back in the early 2000s. We can look at marijuana stocks in, was it 2016, 2017? Altcoins and meme coins, cryptocurrencies that have crashed, NFTs. People will sell you these things. It's a hot trend, and people like to hop on trends, and they think that their portfolio, their sort of longer term portfolio, is inadequate because there's this new hot trend. Like right now, it's AI. Everybody wants to invest in AI. Chasing these trends and even investing in like technological revolutions generally does not play out well because we don't know which companies are actually going to succeed in the long run in these industries. And they'll launch new funds based on whatever is hot in the market so that they can collect assets and charge fees on that. So stick to your plan. Don't worry about what the hot trend is of the day. If you're a long-term, like low-cost investment, diversified, like index fund investor, you're probably capturing all of the new hot trends in your portfolio anyway. And beware of benchmark switching, which is where you effectively benchmark your portfolio to whatever did really, really well last year, right? So anytime we have a year like this year where the US markets are doing really, really well, inevitably people say, well, why shouldn't I just invest everything in the US market, right? But if this was in the early 2000s or mid 2000s, everybody was talking about things like emerging markets because that's where all the returns were. Everyone was saying, why don't I just put my whole portfolio into emerging markets? So don't chase those trends. Don't try to buy the thing that went up the most yesterday. Just stick to a long-term, well-researched approach. I mentioned this with the tax slide. There's a lot of complex strategies out there, not just with tax, but also with things like insurance, with investments. Complexity doesn't mean value necessarily. And often the simple low-cost strategies are the ones that do the best in the long run. So we see this stuff all the time where people are asking about complex tax planning strategies or something, and they haven't maxed out their TFSAs, for example, right? So you really need to focus on the simple stuff first. And if you get the simple stuff right, like basic things like maxing out RSPs, having a low cost diversified portfolio, TFSAs, education funds for kids, the things that are relatively simple and available to all of us. If you get that stuff right, you're 90% of the way there. You don't necessarily need a complex portfolio of private assets or private credit or anything like that. Some people might want that. That's fine. But that complexity usually comes at a cost and does not always add value in the long run. So focus on the simple stuff. Get that right before you start looking at anything else. Preventive wealth. So like preventive health, we need to address risks before they become problems, right? So like preventive medicine, rather, things like regular checkups and vaccines and diet and exercise. We do these things to prevent an issue later on. And, there's a saying, offense wins games, defense wins championships. And that's very true in financial planning as well. So things like getting the right amounts and types of life insurance, disability insurance, diversifying your portfolio against risks, estate planning documents like wills and powers of attorney, budgets, reducing debt. These are the defensive components of sound financial planning. And if you get those things right, then an unforeseen event is unlikely to take you off track in your financial plan, right? So you need to play defense before you can go out there and play offense. Like there's no point in spending all your time trying to invest your money if you don't have disability insurance, because then if something happens to you, you might need to withdraw from the portfolio anyway. So play defense before you play offense, address risks before they become problems, and don't let unforeseen events take you off track. And finally, what are you retiring to? So again, I know we've got a diverse group here. So some people are probably thinking about retirement or retired themselves. Others are probably just starting their careers. This is something that I have a personal experience with my own father, which I'll mention in a second. But people tend to get their identities wrapped up in their profession, and this is really common amongst doctors. I once had an 85-year-old family practitioner that was still working, and he didn't need to be working for financial reasons. He wanted to work because he was a doctor, and that was who he was, and all of his values and his entire identity was baked into him being a doctor. And that's fine, except for when you stop being a doctor, and you never stop being a doctor, but when you stop practicing medicine, rather, you need something else, right? And again, this is very common amongst physicians where they don't retire because they don't know what they're retiring to and who they are outside of medicine. So I'll give you a quick story about my father. My father was a small businessman out here in BC, and he owned a tile store, like home flooring and tiles. And he didn't love tile. In fact, he didn't care for tile at all. It was just one of the only things he knew about because he used to work in his brother's tile store. And so my dad was really big on financial independence and investing and saving, and he used this business essentially as a way to reach financial independence. So his only goal was to build up enough money so that he could sell his business and retire. It's all he cared about. Really active guy. Was a scratch golfer at one point. He used to swim 80 laps at the pool 3 days a week. He used to travel a lot, ate healthy, had a six pack going into his 50s. Really, really social guy as well. And as soon as he sold the business at age 58, things started going downhill for him. And within about 6 weeks of selling the business, he had played all the golf he wanted to play, he had traveled, and he came back and he went and worked for the guys that he sold the business to. Not because he needed the money, but because he just missed the camaraderie of his old employees and colleagues and missed being kind of in the shop. But it was different because it wasn't his business anymore. And so he quickly kind of spiraled and went downhill because I believe that he gave up his identity. He was the tile guy. He sponsored all of our baseball games and soccer games, and people would come up and approach him and ask him about tile. And that's kind of what his identity was. It was his business. And after he sold it, he didn't really know what he had left. And unfortunately, he wasn't retired for long enough to figure it out. He took his own life about 18 months into retirement. And in hindsight, it wasn't obvious to us at the time that this was happening, but in hindsight, I firmly believe it's because he didn't know what he was retiring to, and his identity was wrapped up in the business which he had sold away. So there's research out there about the phases of retirement, and you can see it on the screen here. But phase one, that kind of holiday vacation, that's the honeymoon phase of retirement, and then we get this feeling lost stage, and this is the one that undid my dad. From there, ideally, there's trial and error, trying to figure out who you are, trying different things, new hobbies, giving back to your community, volunteering, teaching, whatever it is, family, friends. And ideally, you get to stage 4, which is you figure that out and you enjoy a long and prosperous retirement. So know what you're retiring to and try to think outside of medicine as you're getting closer to retirement. And that's it. So thanks again for having me. I guess we probably have lots of time left. I haven't checked the clock, but yeah, we got a bit of time. So I don't know, is there any questions? If not, I can get to some of those questions that were submitted to me beforehand.
Thanks, Mark, for the awesome talk. Some of the questions that were submitted, I think you addressed very well in the talk. So I'll ask about a couple here. There's two that I'd like to combine. One asks about why are Canadian physicians moving to the US due to taxes? And the other one asks minimizing taxes and losses for MDs moving to Canada and to the US.
Yeah.
Planning a move. Wanted to know your thoughts. So yeah, curious how you would answer those questions.
Sure. Yeah. And this is actually one of the questions I didn't want to address because it's so complex.
Yeah.
And I think it goes just beyond tax, right? There's obviously the tax aspect of becoming a non-resident, but beyond that, there's the grass is always greener type scenario, right? Where we're upset about taxes. And I just heard the tail end of I think it was Benjamin who was on before me, and he was talking about this question as well with respect to like the inclusion rate on capital gains and how that's potentially changing. Um, and so we don't like tax. Of course, we don't like tax. We're always looking for ways to minimize tax, as I mentioned, but it's not just about tax. Now, specifically moving to the US, generally speaking, you would face a deemed disposition on your assets when you become a non-resident. So if you were to leave and officially become a non-resident of Canada, there's effectively a taxable event on any of your taxable investments. Um, there's probably ways to mitigate that to a degree. And where your actual residence is for tax purposes is not always that obvious. So CRA goes through sort of a series of kind of tests, if you will, to determine if you're still a tax resident of Canada. Like if you go away and just travel to the US for a year, but you still maintain a residence here that you're not renting out, you still have a car, you still have your country club membership, they're probably going to see that as an extended vacation. Where if you sell all those things and then leave, it becomes a little bit more obvious that you're no longer a Canadian taxpayer. So the actual transactions that happen when you leave, I don't want to get into because it can be very, very complex and depends on a number of factors. What I will say is that when the capital gains inclusion rate announcement came out, I was upset. I took to Twitter and started writing and complaining and just generally being a thorn. And I was actually approached by somebody who was involved in writing the budget. And I had a conversation with this individual, and it was quite enlightening. I'm not saying I like the tax by any means, but at the same time, he kind of talked me off the edge a little bit. And then Ben Felix and I recorded, we interviewed Professor Kevin Milligan, who's a professor at UBC. And that episode of the Rational Reminder podcast was really, really enlightening to me. And I left that conversation with him thinking, okay, maybe the taxes aren't as bad from a general perspective. As individuals, I know we don't want to pay more tax, but in general, maybe there's some relatively good reasons for doing it. But then the last thing I'll say on that is that I started modeling my client's retirement, in many different ways. And I started just kind of creating different scenarios. And so I kind of just created a fake couple who are, 30-year-old physicians, both physicians are going to end up with large corporations over their lifetime, large holding companies of investments. How does the capital gains inclusion rate change impact them? And the reduction to their, what I call the retirement score, which is the probability of them being able to meet their long-term retirement needs, was impacted for sure by the new capital gains, but only a 2 to 3% reduction. So it was not as significant as I was actually expecting it to be. Where the bigger impact was in the expected value of their estate net of tax, and that was about 10 to 12% lower, depending on which levers I was pulling. But I think it's maybe not as impactful as people think when you consider it over a very, very long time horizon. There's other ways to mitigate the tax, like using RSPs, using individual pension plans, using TFSAs. Smart planning can get you a long way. So I will write up some of the answers more specifically on the U.S. tax issue because it's quite complex, and I'll pass that to the organizers, and they can share it later.
Awesome. Let's switch to maybe one of the questions from the chat. Bone Deep asks, I know a few doctors, and one common thing I've noticed about them is that they put a lot of their money into their own practices or maybe real estate. Are there any risks with that people might not always think about? And if so, how do you suggest they protect themselves? There's also another question that kind of talks about starting a new practice. So maybe if you're commenting on kind of investing in your own practice, someone else asks, are you able to speak to any common mistakes when starting up a clinic from scratch?
Mm-hmm. Yeah, both great questions. So with respect to Bawandeep's question, I mean, I think the kind of big obvious one there is what we call concentration risk, right? And this is essentially where all or too much of your money is in one place. And when we think about corporations, this was really, really common even before the capital gains changes, where a lot of physicians would pay themselves only dividends. They wouldn't have any RSP room. They wouldn't be contributing to the Canada pension plan, and they would build up the value of their holding company over time. And to me, that was a concentration risk just from a tax perspective, where if there's an unseen change to the taxation of small businesses, like an increase in the capital gains inclusion rate, you're now disproportionately affected because you're holding too much wealth in one place. And so there's diversification just from a tax standpoint, where you have diverse income streams from different sources like RSPs, TFSAs, CPP, and your corporation. But the same applies to investment assets as well, right? So I mean, real estate's the big one. I'm from BC. I grew up in the suburbs of Vancouver. I can tell you that real estate is a hot topic here, and many people have become obscenely wealthy through buying real estate. And I think there's some survivorship bias in that. Like I always joke, like go ask people in Edmonton if they've had the same experience. And I know Ben Felix has done a lot of work on housing price increases in Canada and the difference between different cities and whether it was better to rent or to own. But the experience that many of us in Ontario and BC have had is not normal, right? Go ask the Japanese how that worked out for them, right? And I'm not saying the real estate market is going to crash. Far from that. I'm saying I have absolutely no idea. But going back to playing defense, diversification is one of the best ways to prevent catastrophe. So concentration can build wealth if you're right and if you're lucky, but most people will likely face some pain if they concentrate at some point. So if you like real estate, that's fine. Just know the risks. Keep in mind there's other risks that you're not seeing, like political risks and interest rate risks, which are not that obvious when you own real estate. But like I used to own two rentals and I sold them and I'll never go back. I hated it. Worst landlord ever. Didn't enjoy it at all. And when it occurred to me as I owned these things, I was like, I have these two little properties in this tiny little corner of the world that I call Vancouver, British Columbia. And like the concentration risk there is quite insane because a new premier could change rules, tax changes, federal tax changes could disproportionately affect me, right? It's just two addresses. So I think diversification is the best defense against that. And same with putting the money into your practice. Um, you can grow your practice. Most business owners are guilty of this as well, like not just physicians, where they spend all of or they pour all of their money back into the business. And yes, that's how you have to grow a business, but you need to diversify as well, right? So don't put everything back into the practice. Don't put everything back into the business. Don't put everything into real estate. Diversification is essentially protection from those risks. And the second half of the question, I don't know that I can speak to with any real authority. I don't have a lot of experience with like systems and that type of thing in a new clinic. A lot of the clients that I've worked with over time were sort of early to mid-career physicians where a lot of that was taken care of already, where they'd established a practice. And I worked with many physicians in many specialties as well, so not all of them had to build practices. So as for mistakes when you're building a practice, I think I'll have to defer or skip that one. Great question.
Lots of other questions in the comments. I'll go back to some that were submitted. Two kind of common questions that I think get asked quite a bit on forums, but for those here, might be some value and something new. The questions are about balancing line of credit debt repayment with investing and the best
Hmm.
approaches when it comes to taxes, of course. And there's also a second question, kind of on a similar note, but as an early career MD, this person asks, should you fill up your TFSA RSP or pay off your mortgage or keep as much money in the corp and invest from there? So again,
Yeah.
two common questions kind of about managing debt, but I'll let you speak to that.
Sure. Yeah, thanks. And you probably can't see it because of the blur here, but the sign on my background says keep finance personal. And that's
Mhm.
what I mean by that is it's very, very, I hate rules of thumb, like hate them. And it's not because I don't think that none of them are useful. I just think that we have an over reliance on rules of thumb, right? And a lot of the questions that we get from a general standpoint are give me a rule of thumb so that I can think about this, right? And those frameworks and models might be helpful, but I'm hesitant to say do this. Having said that, the first question I believe was paying off debt versus investing. Was that right?
Yes.
Yeah.
Balancing line of credit debt specifically is what I'd ask for, but I think could be
Okay.
applied to.
Yeah, yeah. So and now line of credit debt typically is relatively low interest, usually, assuming you have a secured loan against your home. Um, man, there's the mathematical answer and then there's the emotional and psychological answer to the question, right? And I am really big on not optimizing mathematically to the detriment of everything else. I'll give you an example. Back in Oh, I think it was 2015. So it was after my father had passed away. My mom gave me some money from his estate. So I had a relatively, a relatively large to me chunk of money. And I had debt at the same time. I had a big line of credit against my home. And what I was going to do was use that money to pay off my line of credit and then immediately borrow the money back and invest it because doing so would make the interest on that line of credit tax deductible for me. I'd be in the same position from a net worth standpoint. My assets and liabilities would not have changed, but the interest on my line of credit would have been tax deductible, which would have been a benefit. At the time I was 30, I still have a very, very high investment risk, relatively stable incomes. My wife is an engineer. She does very well. So I am the perfect candidate for being able to do this thing where you borrow to invest. As soon as I paid off the money on the debt on the line of credit, the relief that I felt was so great. And the impingement to my monthly cash flow and the reduction in that was such a boon to me that I never borrowed the money back. And here we are 10 years later, and I just never did it. Mathematically, I would have been way better off in borrowing that money back, but I never did, and I'm very happy that I didn't. So paying off debt versus investing. I mean, yes, mathematically, you can look at the expected return on the portfolio after tax versus the cost of carrying the loan after tax and maybe come up with something. But again, I'm hesitant to say do it because that's what the math says, right? And every debt in Canada is variable to some degree, right? We have fixed rate mortgages. Most of them don't go past 5 years. There are products that go longer than that. But in the US, you can get a 30-year mortgage, for example, and the interest rate is known throughout the entire life of the mortgage. In Canada, everybody is on a variable rate mortgage or line of credit. So borrowing to invest comes with relatively high interest rate risk. And we saw that materialize in a big way over the past few years. So you have to be able to tolerate swings like that. You have to be able to afford swings like that. And let me put it this way. I don't think I've ever met anybody who didn't meet their goals because they didn't borrow enough money to invest, right? So generally, I think a good framework for doing these things is to hedge both sides of that by doing a bit of both, right? Then you can anchor to whichever had the better outcome at the end of the day, right? If interest rates went up, you can say, good, at least I paid off some of that line of credit. If interest rates stay low and the market does really well, then you can anchor to the fact that your portfolio has done well. And sorry, what was the second half of the question now?
So the second half of the question was, as an early career MD, should you fill up your TFSA and RRSP or pay off your mortgage or keep money in
Yeah.
the corp, and of juggling
Yeah.
that?
Yeah, same thing. And I think this goes back to my comments on concentration risk and being diversified, right? You don't know, you can make smart decisions, but you do not know what the optimal outcome is. Like you do not know which of those things is going to give you the best outcome in advance. Again, you can model and spreadsheet this out all you want, but you just really don't know. And so what we're trying to achieve, I think, as individuals is good financial outcomes over long periods of time, not the optimal financial outcome with hindsight. And so I think, regardless of the stage of your career, and I hate rules of thumb, but if I have to give you one, I'd say do everything to some degree. TFSAs are fantastic. RSPs are, I'm a huge fan of RSPs. IPPs, I know there's a question about IPPs in the chat. Those are great. Having money in the corporation gives you more flexibility on income and retirement income down the road. Paying down debt is never the worst thing that you can do with your money. It's not always the best, but it is never the worst thing that you can do. So take a diversified approach.
Certainly better than buying a loaded Porsche with a max line of credit. So definitely, again, not a bad idea.
Yeah.
Speaking of IPPs, there was a submitted question about, can you please review the basic principles of IPP or individual pension plan? And then a comment here, a question in the chat as well about pensions as well. So I think it would be
Sure.
a good discussion.
Yeah, sounds good. IPP is individual pension plan. And I see the loony Dr. Mark Soth is here with us today. He's probably better off answering these questions, by the way. But IPPs they're great. I love them. And essentially, what an IPP is, it's often called a supersized RSP, right? And really, what it is you are building a defined benefit pension plan for yourself. So if we think about the gold-plated pensions that maybe many of our parents or their generation would commonly have, where the benefit that you get is defined in advance. That means I know the amount of income that I can expect in retirement from this pension plan, which is unlike RSPs where you're investing the money and you don't know how much money you're going to have. When you create an IPP for yourself, you're using actuarial math to determine what the benefit needs to be in retirement, the monthly income benefit, and essentially reverse engineering how much needs to be contributed to that plan to more or less guarantee that you can get that benefit. And so just the same way any company would create a pension for their employees, an IPP is you as a physician using your corporation to sponsor a pension for you as the employee and the shareholder. The contribution limits to IPPs get pretty big, and after around age 40, they start to exceed what one could put into an RSP. So it allows you to take even more money from your professional corporation and put it into a registered plan, which is very, very tax efficient. And then at retirement, you have a few options on how you withdraw the money. You can keep the plan open, you can purchase an annuity, or you can effectively start withdrawing from it. So high level, kind of think about it like a supersized RSP. Actuaries need to get involved. They're still relatively cost effective. Like the actuaries we work, I think, charge something like $1,600 a year for the implementation of these things. So they're very, very cost effective. Not for everybody. You generally need a high salary because it's based on employment earnings. So if you're paying yourself only dividends, for example, or have been for a long time, that's not necessarily going to work right now. But if you're a high earner paying a high salary and value the sort of certainty of knowing in advance what you're going to be able to draw from the pension, I think they're fantastic. And then the second question is about CPP. I love
Yeah,
CPP.
lower down, there's a question, yeah, from Chantal about CPP
Love
and
it.
opting in out.
Yeah, yeah. And I get this all the time. So for those that don't know me, I spend a lot of time on Twitter, and I tweeted about CPP the other day and got into all sorts of fights with people about it. And I know this is going to happen every time because people are very, very vocal about CPP and the idea that, well, I could just take the money and buy the S&P 500 and I would outperform. So I'm actually working on an article about this because it's just not that simple. You might outperform, we don't know. But at the end of the day, the two biggest financial risks I think that we face are longevity and inflation. And that's running out of money early or the cost of living rising at a rate that is unsustainable for your portfolio, forcing you to withdraw more money over time than you can sustainably do. There are virtually no perfect hedges for that problem of living a long time and the cost of living going up, except for CPP. So CPP is indexed to the consumer price index, CPI, the consumer price index. Yeah, that's right. After you start taking it, so it's indexed to inflation. Before you take it, it's actually indexed to wage inflation, which is the rise in average earnings over time. And wage inflation tends to actually go up faster than CPI or the cost of living. So before you're taking CPP, CPP is growing and growing and growing. And then when you take it, it's indexed to inflation and it pays for life. If you live to be 140 years old, you're still going to get your CPP check. The only people I know that complain about CPP are those that are working and contributing into it. I've never met a retiree that didn't like their CPP check. 2022 is the perfect example of how it solves for things like what we call sequence risk, which is when markets are down and you're having to draw from the portfolio. 2022, everything was down. Real estate was down. Bonds were down. Stocks were down. Portfolios got hit really, really hard. CPP payments went up like 6.4% that year because inflation was high, right? And so it's a great, great hedge against these problems. I'll talk your ear off about CPP all day long and why I think it's such a major benefit. And I think if I could contribute more to CPP myself, I would.
So there's a few submitted questions and also some in the comments here, kind of on the notion of this assembling your Avengers team of
Yeah.
financial support, if you would.
Mhm.
The question itself reads, any general guidelines for how to go about building your team of financial professionals, accountant, financial planner, estate lawyer. I know lawyers were a bigger request this year. We actually have another session about that as well. So for those who maybe have more questions, we have recordings that are going to come out later. But if you'd be willing to kind of comment on that, I think
Mhm.
another question also asks about financial advisor and financial planner, some of the nuance and difference between that.
Sure.
That'd be helpful for the audience.
Yep, great. So it's tricky because not everybody needs everything, right? And just the way that, my family doctor, well, I don't have a family doctor anymore, unfortunately, but I did. And that family doctor was the first person that I would go to when I had a health question. And if I needed a referral to a specialist, then I would leave it in their hands to refer me to the correct specialist. And so I don't necessarily need every type of medical specialty in my lifetime. I just need somebody to tell me who I need to interact with and when. And I think a good financial planner can be that sort of at the center of your wealth, the same as a physician, a family physician would be at the center of your health. Now, many of you, I'm sure, are not necessarily working with a financial advisor or a financial planner. That's why you're here today, putting on these great conferences so you can learn about this. But an accountant, I would say, almost unilaterally is going to be what a good accountant will be money well spent if only because you don't want to file tax returns yourself. Even if you're not I'm not incorporated, I have an accountant. My taxes are relatively simple. I have an accountant. I pay a professional to do this, take the liability and the thoughts off of my psychological plate, so to speak, and just have somebody else do it. I also have somebody who mows my lawn, and it's $60 a week, but I just don't want to do it, and I just don't have to think about it. And somebody just shows up and does it. If you value good advice and paying for that advice, then I think a good accountant is almost non-negotiable. Um, Estate lawyers, you need them less frequently, but they are very valuable. Please do not do your own estate plan. Like, you DIY your investment portfolio, sure. Don't DIY your taxes and your estate plan. It's too complex. And so many times people come to me and say, oh, my situation's actually not that complex. And I spend 10 minutes talking to them. I'm like, your situation is very complex. Even my own situation, I didn't think was complicated, but a friend of mine's an estate lawyer. And as we started getting into the questions around care for our minor children and all this stuff, I was like, oh yeah, no, this is really, really complicated. I don't just want to do this online. So you need a good estate lawyer, but less frequently than you would need an accountant. Now, as for how to actually assemble that team, a good referral goes a long way. If you have friends or colleagues that are very happy with the services that are being provided to them by those professionals, that means a lot, obviously. That's sort of firsthand proof. The internet is your friend, generally speaking, when it comes to researching. Like I kind of said in the beginning of my presentation, Google people. Like, you're not going to get the full picture of them, but you will see if they are creating content around financial planning for doctors, for example. And I'm kind of tooting my own horn here, but I write a lot on Twitter. We have our podcast. And a big reason we do this is to show people what it's like to work with us and how we think about problems. So if there's people like that you're following that you think are great and are creating content specifically for you, that's usually a good start. I will say interview more than one person for any position, because you just don't know what you don't know. And I cannot tell you the number of times somebody has come to me saying, yeah, I have an advisor. And what I actually find out after is they've really just got an insurance salesperson that's been selling them insurance, and they think they have a financial plan, but they don't, right? So you don't know what you don't know. And that's why high income earners in this country generally get taken advantage of quite a bit by salespeople. So interview many people, Google, ask friends for referrals. You don't need every type of professional at all times. If nothing else, and you're open to it, find a great financial planner, and they should be able to have the referrals lined up for you as well.
The questions in the comment or in the Zoom box that have kind of popped up at the bottom are interesting. This is not one that was directly mentioned as a kind of submitted question,
Mhm.
but something I have seen on the Physician Financial Independence Facebook page, and there's obviously lots of threads. At least I'd see a couple a week commenting about what things can you pay for, or sorry, if you can have coverage or a on your corporation, can you put your phone bill and that sort of thing, and your phone expenses and whatnot. And I don't want to get into the nuance of the tax of it, because that's not the purpose of this conversation. But it looks like Philip's asking, not sure you can get to this, but can you comment on having a health spending account, paying for a gym memberships, other things not covered by basic insurance?
Yep.
Wondering what your thoughts were there.
Yeah, it's a great question. So HSAs, or health savings accounts, um, they're really, really neat. And so they let your corporation pay for your personal qualifying medical expenses, basically without tax. It's like one of the very few only tax flow throughs that we have available to us, where we can earn $1 of income in our corporation and actually get it to our back pocket without paying any tax on it. There are limits on how you can use them. And it gets a lot more complicated because CRA a few years ago kind of came out and took a look at these things, specifically with respect to single shareholder corporations, which many of you will be, right? I mean, in a lot of provinces, the college determines that you can't have more than just a physician as a shareholder of the company. And what CRA basically said is like, is this a benefit because you're actually a shareholder of a company, or is it because you're an employee of your company, right? And there's a lot of ways to look at this to make that determination. But the point is that you have to be very, very careful setting them up, because CRA has these things on their radar. If not set up correctly, you could face what's called a shareholder benefit, which basically means CRA goes, no, 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 you only got this HSA because you're a shareholder of a company, and now we're actually going to make you pay tax on it. So a good accountant will help here, because it's largely a tax mechanism that we're employing with an HSA. There are a number of HSA providers out there in Canada. If you search HSA Canada, you'll get all sorts of companies that pop up that do these things. I don't want to give a necessarily a referral here on the call or anything like that, but there's a couple I think that are better than others. As for what they can cover a lot of things. I mean, think about like an extended health plan that covers things like hospital stays, or acupuncture. You can pay for those types of things. You can, I believe, even pay for the premiums on certain types of insurance. I want to say disability insurance. I might need to get fact checked on that. But there's a lot of things that you can use these HSAs for. And I think if you can qualify to open one and you can do it with the help of a good tax planner and an accountant to make sure that you're on side with it, they're really, really neat.
Awesome. There's there's a question here that was submitted previously about the best way to manage corporate bloat, and I think I've
Mhm.
seen many threads about kind of withdrawing from the corp for purchases, moving, that sort of thing. So I don't know if you had any comments here.
Yeah, but by corporate bloat, I assume the question means getting the corporation that's getting too large relative to other accounts.
Yep.
Yeah, we kind of talked about this a little bit earlier, but with respect to diversification, nobody wants to pay tax today, but the only way to get money out of your corporation generally is to pay tax, right? And so you kind of have to rip the band-aid off in some cases and just take the money out, pay the tax, and deal with it. And in most cases, that's the right move, right? And so corporate bloat, it's tough because very, very high earning specialties will have this problem. And there's just not really much that you can do about it in a reasonable way, right? If you're making $1 million in revenue or medical billings per year and you're paying out a $250,000 salary, you're maxing your RSPs, your TFSAs, you're going to have hundreds and hundreds of thousands of dollars invested in your corporation over time, right? That's generally a good thing and is really the purpose for incorporation for physicians is that tax deferral. So it's not a bad thing to have too much money in your corporation from the perspective that it's a good problem to have. But I think just the most common things like max out your RSPs, max out your TFSAs, maxing out education funds for children, having your corporation purchase the insurance policies that you have as a shareholder allows you to use the corporate expenses or corporate dollars to pay the expenses rather. IPPs, which we touched on briefly, individual pension plans allow you to make relatively large deductions directly from your corporation to the individual pension plan. Paying dividends and this is getting a little bit nerdy on the tax side, but when you have passive investment income in your corporation, you pay tax on it, but then some of those taxes are refundable to you if you pay dividends. And so there will come a time where you might want to start paying out more dividends from the corporation just to get that tax back. So I think to the degree that's reasonable, take money out, put it in other places, diversify your tax sources, as I mentioned. Um, that's probably all you can really do about it. Otherwise, I mean, you can certainly take all the money out of your corporation at once. You're well within your rights to do that. You're going to face a very large tax bill. I can see Mark South vomiting at the concept of doing it. But I mean, you could do that. I'm not saying you should, right? But if corporate bloat is really the problem, the only thing stopping you from taking the money out is paying the tax. And you're going to pay the tax one day, whether you like it or not. So decide on the timing of those taxes.
Mark, I don't know if you had any comments. I know your session is next. It's at 3:15. We're probably going to close out here around 3:10, but
Sure, yeah, we'll talk about some of that, but yeah, a smooth, silent release would be better.
For sure.
very good. Very good. Um, there were a lot of submitted questions, still some that I can get to, but Mark, is there anything that, as we've been talking that you've thought of that maybe hasn't been covered yet that you wanted to pay some thought to?
No, not necessarily. I think there's so much out there, right? It's hard to distill the entire compendium of financial planning knowledge down into a 1 hour presentation, of course, but everyone's going to have their own questions that are very personal to them. Um, I enjoy conversations with people. And while, yes, I'm biased because I'm an advisor and financial planner, if anybody wants to reach out, chat about this stuff, I can't give you advice if you're not a client, but my inbox is always open. Somebody's posted my Twitter handle a couple of times. I'm pretty active on there, so you can follow me there and send me a direct message or um, just Google me and you'll find my email address and feel free to reach out.
Right. Looks like Matthew just popped in one more question here. We probably have time for it, and then we'll close out the breakout rooms to give us some time to rest
Sure.
before the last session. But the question is, do you ever recommend participating in life insurance, example for estate planning, or are there good alternatives for that?
Yeah. Do we ever recommend it sometimes? For sure. It's a tool, right? Like any product, it's really just a tool, and tools aren't necessarily good or bad things. They just need to be used appropriately. So my problem with things like participating whole life insurance is that these policies are generally oversold to people. Like there are far more people walking around with whole life insurance policies than there should be. Um, there are some benefits to these types of policies. They can get very, very complex. But I will tell you this, the main sales pitch behind a participating whole life insurance policy owned by the corporation is the tax savings, right? And if you're looking at an illustration of one of these insurance policies over time, what they're going to show you is look how much tax-free money your estate gets, right? And that's potentially true, and that's potentially a good thing. But again, going back to my tax slide, you don't necessarily want to pay the least amount of tax. You want the best after-tax outcome. So what I find when I model whole life insurance policies for my clients versus a reasonable alternative like a low-cost diversified index fund portfolio, there's a break even somewhere where the net value of the estate after taxes, after probate, and everything else can certainly be higher with the investment portfolio than with the insurance. A lot of that depends on when you die, of course, right? If you die early, the insurance generally is going to look better than if you die late in life, right? So where I think these things are interesting is if you have a liquidity problem in your estate, like if all of your assets are real estate and you want to pass that real estate on to your children, which I don't think is a great idea anyway, but let's say you do, and you know there's going to be a large tax bill at death, but there won't be other assets that you can use to pay the tax bill. Insurance will inject liquid capital into your estate to manage those problems. And I think it does a very, very good job of that. But most people don't need a big injection of capital, regardless of when they die. They have an insurance risk right now, which is a low probability, high impact event, like they pass away mid-career, and the millions and millions of dollars of earnings that they had yet to earn are now gone, right? And so you have a financial risk, your family has a financial risk. You want to transfer that risk to an insurance company and you want to pay them to take that risk for you. That's why things like term insurance are great. But very few people need an insurance payout at age 95. So I think look at insurance as, do I have a need for insurance first and foremost? If so, what's the most effective way to cover that risk? Whole life insurance can be a great product for estate planning. I don't universally think that everybody should buy it. Yes, the new capital gains taxes have made it perhaps more attractive because money in an insurance policy is generally exempt from tax. But I don't think, again, there's a rule of thumb where you can say these are good things or they're bad things. You have to look at your own situation to determine whether it's the right tool for the job.
Thanks for adding on that question at the end, and thanks so much for the presentation and for the talk.